Hello and welcome to Kitco Mining's Digging Deep, sponsored by Revival Gold with me, Paul Harris, in which we take a deeper dive into mining and exploration news. Joining me today is Joe Mazumdar, editor of Exploration Insights. Joe, welcome back to Kitco.
Hey, Paul, how's it going?
All good, thank you. Before we start, please note that Kitco Metals and Kitco Media provide news services only and do not offer tax, legal, or investment advice. The opinions expressed are those of the contributors and do not necessarily reflect the views of Kitco Metals. For complete terms and conditions, visit kitco.com. And don't forget that if you like what you see, please hit that subscribe button. Joe, let's start with gold. Gold's hitting record prices of over $2,500 an ounce, and all the producers have now pretty much reported their June quarter results. And both you and I have been analyzing things such as all-in sustaining cost margins, free cash flow, and many other things. The leading 9 precious metals producers that I follow produced an aggregate 6.4 million ounces in the June quarter, which was up 17% on the March quarter, but down 37% on a year ago. The average all-in sustaining cost was $1,454 per ounce, which is up 1.8% on March and 12% on a year ago, while the all-in sustaining cost margin averaged 38%, which is up 31% from March and 34% a year ago. Joe, so inflation is still a thing, but gold price increases are so far outpacing it, allowing for margin growth. What are some of the things you've been looking at?
Well, I mean, I looked at a number of companies as well for the upcoming letter that will get published this weekend. I looked at about 20 companies, mostly North American listed, 200 billion cumulative market cap companies for the first half results. And what I noticed that costs, like you said, are up, but gold price is making up for it. And most of the cost issues, 6 to 8%, depending on the company, are like treating more low-grade material was an issue, underground development to try and access high grade, stripping in anticipation of accessing high grade in an open pit, a lot of power issues in West Africa, like Cote d'Ivoire and Burkina Faso, in terms of power availability, that puts some plants at lower capacity, increased costs. And then also the increase in gold price had a negative impact on their costs because their royalties and payments to third parties also went up. And then there were some weather-related issues, like either there are fires in North America or some places got a lot of rain, which also had an impact on plant availability. Like you, I looked at margins. I look at gross margins, which you can get off the income statement, and the AIC margins, the all-in cost margins. But that's non-GAAP measure, so it can be manipulated. But I found that the average gross margin was 46% for these companies, which is healthy. Because all-in sustaining costs includes the sustaining capital, those margins average about 10% less. On the low side, in terms of margins, I found that Equinox, Anglo Gold, Allied Gold, and Coeur had the lowest margins, and the highest margins were companies like Lundin Gold, Agnico, and Alamos.
Okay, and a lot to unpack there, Joe. Let's start with the weather aspects in Africa. El Nino is really hitting hard there, causing a lot of drought conditions, particularly, for example, in Zambia. Had a really good conversation yesterday with the CEO of Greenco, which is an energy trader and a supplier there. Zambia is going to a 17-hour load shedding in the near future, so big impacts there. Now, in terms of the aggregate cash held by the majors, that's fallen from about 12 billion at the end of March to 11 billion at the end of June. Aggregate debt has fallen from about 20 billion to 18 billion, but most of this reduction seems to have happened at Agnico Eagle Mines. I understand that many companies enjoy low-cost debt, but it does seem they're not taking advantage of high gold prices and growing margins to pay down debt more quickly and make their balance sheets even more rock solid. And of course, even cheap finance means that there are finance costs each quarter. What have you seen there?
So two things I looked at was net debt. So you're taking long-term debt and netting out working capital. Again, this is net debt's a non-GAAP measure, and so companies manipulate that as well. And some people use cash. I like to use working capital because working capital suggests that that's the money that's going to be gone within 12 months. And so when I looked at of the same sample group, the average net debt level of these companies was about 275 million positive, which means, unfavorable, but not egregious with respect to net debt. But that average belies the range. I mean, the range is huge between, like a Newmont, post Newcrest acquisition is sitting about, on my calculation, on a net debt basis, got about 2.3 billion. And then you've got companies with negative net debt as well, which is really good. And from what I can see, there's about half of the companies that I have, 10 of the 20, have negative net debt or very low positive net debt, which is very, very encouraging. But we also got to realize that it's not just long-term debt that financing these companies, but some of these people do streams, some of these people do offtake agreements and that. And those sort of facilities are another form of debt that sits on their liabilities, but we don't count as net debt. So, there's other things happening, and especially with the higher risk, geopolitical risk assets, that might be the only kind of funding they get. So we probably need to take a look at that. But in terms of financing costs, if we look at financing costs, I got cumulatively these companies spending about 680 million on financing over the first half of the year. But since, this is a big range, with Newmont obviously with the biggest debt paying the most financing costs, I try to look at it on a proportionate by revenue. So how much are they paying in their financing costs normalized by their revenue in terms of the size of the company? And so when you look at it, the average is around 2 to 3%. The Equinoxes and the Heclas are at about 6 to 7%. And so that would be high. There are a bunch of companies with lower financing costs and some with zero, like Lundin Gold, to your point about eliminating debt. That's what they did. They were generating a lot of, positive free cash flow from their high grade, low cost Fruta del Norte project in Ecuador. And that gave them enough cash to take their debt out completely. So now they're sitting at the end of June with no debt, which is very positive.
Now, in addition to being debt-free, Lundin Gold is also leading the way on the dividend front. From my analysis, only 3 companies increased their dividends at the end of the second quarter: Anglo Gold Ashanti, Aura Minerals, and Lundin Gold. Joe, I think there was perhaps an expectation that the Joe quarter would be a bonanza quarter for the Goldcos, yet only 3 companies are sharing more of the wealth with their shareholders. Why is that? And if they're not increasing their dividends or paying down debt, what else are companies doing with their money?
So what we have to look at this is basically when we look at the cash flow statement, we've got operating cash flow and we net out cash flow used in investing. And once we net out that's when we get this thing called free cash flow. And free cash flow, again, is non-GAAP. And so people can manipulate the term. But when I do it, and in my study, I just take right off the free cash flow, the cash flow statement. And when you look at that, these companies generated about $2.7 billion over the first half in free cash flow, an average free cash flow of about 135 million. But despite the positive mood in gold price, there's quite the spectrum. About a third of the companies generated no cash flow and negative free cash flow, so they couldn't even offer a dividend, because the free cash flow that you generate can be used to pay dividends, can be used to finance new projects, can be used to buy back shares, or to pay down your debt. So there's a lot of alternatives for it. But when you don't make any money, which is what a third of them didn't do, there's nothing to spend. And so what you see is that like you said, there was some companies that increased their dividends, and some of the seniors, some of the best dividend, on a per share basis, are paid out by companies like Agnico, and Newmont. And then other high dividend payers are like Pan American. They also pay out high dividends on a per share basis. So if you're looking for dividends, those are the sort of companies that you want. But if a senior's paying high dividend payout, that would be the one to go. So it's not just their dividend policy, but it's their ability to generate enough free cash flow to pay you those dividends quarter on quarter. Because just saying that that's my dividend policy and actually having the free cash flow to back it up could be two different things. But another thing people should think about when they look at free cash flow is I look at free cash flow yield. So I take the free cash flow per share so I can normalize it by the size of the company. Take that over the share price, and that gives you the impression or the idea that how much of their share price is backed by free cash flow. And with that, you can see the companies that do really well and the companies that aren't doing well. So it's another metric to consider.
Now, Newmont is head and shoulder above other gold companies in terms of the cumulative amount it's returning to shareholders. I think through the first 6 months of this year, it's returned almost $900 million to its shareholders. But its all-in sustaining costs are just below the group average. So it's quite mediocre in some ways, outperforms in others. Joe, we've talked about, you've mentioned a few companies in your comments. Are there any second quarter results that caught your eye either positively or negatively for some reason?
Yeah, I guess Equinox situation, sort of like I picked them at the end of last year. I bookended for my subscribers if they were interested in producers and gold was going up. Here's a company that gives you a lot of downside protection, would generate a lot of free cash flow. That would be Lundin Gold. And then I bookended that with the leverage provided potentially by Equinox Gold, because it was very levered in terms of having a higher all-in sustaining cost. But they've had a lot of issues over the first half of the season of the year. Their Arizona project had a lot of plant availability issues because of rain impacting their open pits and their geotechnical stability of those pits. And so that reduced their free cash flow. And also because of costs, their project in California, Castle Mountain, that operation was suspended. They're looking at expanding it and having a phase 2 program, but in the interim, they're not producing there anymore. So I was surprised at how badly they had done in terms of return. Then when I looked into their financials, you can understand why they've done so badly.
Well, on the positive, a number of companies are at or very close to 52-week highs, including some companies that were until quite recently quite challenged. And I'm thinking there of IM Gold and New Gold. They've been really surging ahead. We have a lot more to come, but we're going to take a brief break for a word about our sponsor, Revival Gold.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million-ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
Welcome back for part 2. We really appreciate our sponsor for supporting the channel and helping to bring you a deeper dive on mining news. Let's talk about financings. Dolly bought deal financings are showing their faces again. Dolly Barton Silver is upsizing a $25 million bought deal financing to $28 million, and O3 Mining has announced a $15 million bought deal. Joe, to what extent or not do bought deal finances indicate institutional investor appetite coming back into the space?
So the way I would gauge it is that bought deals are a sign that basically the brokerage firms and the investment bankers there think that they have enough clients that are interested in your company specifically or in the sector generally, which overall is a positive. But what we need to look at is if the bought deal gets closed quickly. So what the company gets the money at that share price regardless, because it's been guaranteed by a consortium of banks and brokerage firms. The problem is if they don't sell it completely. If they don't sell it completely, then we have an overhang. So even though the company gets the money at that share price, they can still have their shares being sold off in the market by those same banks and brokerage firms because they don't have enough clients. So to monitor this, we would want to see these transactions close quickly. And then in a real positive, a big positive would be if the share price continues to go up after the close, because then they left a lot of demand still out there. And that is really a positive for the market as a whole.
Well, several bought deals seem to get upsized, and Dolly Varden's is an example of that. So is that a case of, obviously there's demand available and them not wanting to leave any money on the table?
Yeah, and then the problem is that sometimes it's good to leave money on the table, because then that forces that money to buy it in the market, and that will get your share price up. But given the volatility of the market and people trying to get funding for like not only a year, but sometimes for 2 years of expiration, it makes sense that the companies are taking what they can when they can, especially your non-cash flowing juniors that are all about the drill bit.
Okay, now with the main gold shows coming up in September, the Precious Metals Summit and the Gold Forum Americas, Kitco will be at both of those. Are we likely to see, with the $2,500 gold price, are we likely to see more bought deals announced in the coming weeks?
We're definitely going to see not only bought deals, but we'll see all types of financings probably come up now that the Fed has just announced that they're probably going to start cutting interest rates. That's going to raise all boats right now. And so I should think it would be very active, not only from a financing perspective, but also potentially from an M&A perspective into September, as all these companies start meeting together over the next few weeks in Denver and Beaver Creek.
Well, the last couple of weeks, the news flow has certainly slowed a little bit. And I imagine in the coming couple of weeks, just before these events, it's really going to start accelerate. Companies are going to be putting out their drill results to get some attention from the investors at these events.
Yeah, and we will see a flood because they definitely sort of purposefully hang on to this news until somebody's actually listening. Unless it's a great result that they have to put out anyway, but usually they'll wait until the market is back. And so some people are still on vacation, and so we should see after Labor Day then that sort of news flow coming out.
Well, let's switch to copper now. I hosted Kitco Mining's Copper Masters panel this week with Kathleen Quirk of Freeport-McMoRan, Robert Friedland of Ivanhoe Mines, and Colin Hamilton of BMO Capital Markets. Some notable phrases from that were, soon we're going to have peak mine supply. That was Kathleen Quirk of Freeport. The copper industry faces a Herculean task to fill the forecast supply gap. We're beginning to see the walls coming in, like Indiana Jones and the Temple of Doom. Probably no prizes for guessing that was Robert Friedland. And half the mines built in the past 10 years don't make a hurdle rate at today's copper price. And this is why balance sheets are under pressure and still scare people. That was from Colin Hamilton. Joe, what are your thoughts on some of those the things that people were saying?
Yeah, a lot of that is related to the medium and long-term expectation, which I subscribe to, is that there is a significant gap coming up in production because of deferred projects, not only because of financing, the incentive price not there for them to build it, permitting issues, lack of water or power to build these projects, and also the fear of the capital blowouts that we've seen in some of these projects, which is holding back a lot of the production. So, but near term, we're seeing an issue where China is slowing down a bit, although they're smelting the copper and the TCRCs are still pretty good. That copper cathode that's coming up is going into goods that are being shipped back for export to other countries because the domestic market's not being able to take it. And so we're seeing probably a glut on the cathode market, not so much on the concentrate market. So I should suspect that the cathode premiums in China are probably lower now, but the actual concentrate TCRCs are low, which is actually a positive for a concentrate. The problem, what we're looking at is the incentive price is driven low by a weaker Chinese economy, but in the medium to longer term, which is what your the people you were talking to yesterday were discussing, is real. Because the longer we defer these projects, the gap gets longer and comes to us quicker. Because those probable and possible projects are no longer coming in when we thought that they would.
Okay, thank you, Joe. Now, our viewers can obviously see that panel on kitco.com. And Joe, before I let you go, you'll be putting your analysis out in your Exploration Insights this weekend. Where can people see Exploration Insights?
Yeah, so we publish a subscribers-only weekly letter, and that comes out every Sunday. This one will come out Sunday, and that's at explorationinsights.com.
Well, thank you, Joe, for joining me today.
Thanks a lot for the invite, Paul.
And until the next time, I am Paul Harris, and this is Kitco Mining.